I still believe that silver is going to hit $100 next year, and gold at least 5,000, probably 6,000, maybe more, depending on what happens in the foreign exchange markets. If we get a dollar crisis, if we get a U.S. Treasury crisis, I mean, we're going to get those crises eventually, so it could happen next year. And if it does, then those upside projections are going to be much higher. But I do think that as the world really gets to think about what happened here with the Federal Reserve and their new policy, you're going to see big buying in Asia in both gold and silver and platinum. By the way, the whole precious metals complex is going higher. And so why wait?
Growing instability across financial markets is pushing investors to reassess where long-term value and protection truly lie. With government debt burdens expanding and major asset classes showing signs of strain, confidence in traditional policy tools continues to weaken. Peter Schiff explains that central banks are increasingly boxed in, forced to prioritize financial stability over inflation control, a dynamic that quietly undermines faith in paper currencies. In this environment, gold is not responding to speculation, but to structural pressures, reflecting deeper concerns about debt sustainability and monetary credibility. At the same time, silver is beginning to display characteristics that typically emerge when a precious metals cycle matures. While gold often acts as the first signal of monetary stress, silver tends to accelerate later as broader participation enters the market. Schiff notes that this shift is reinforced by confirmation from mining equities, which are now aligning with metal prices rather than lagging behind. This alignment suggests that investors are no longer questioning the durability of higher metal prices, but are positioning for an extended phase of strength driven by macroeconomic realities rather than short-term narratives. Looking ahead, Schiff emphasizes that the combination of accommodative policy, rising fiscal strain, and global demand for tangible stores of value creates a powerful backdrop for both gold and silver. As international buyers increasingly diversify reserves and investors seek insulation from financial volatility, precious metals are regaining their role as monetary insurance. The ongoing participation of mining stocks further signals that markets are anticipating persistence, not reversal, in the forces driving gold and silver higher. Now, we present the clips from Peter's interview. Before we continue, please subscribe to our channel and activate the bell icon to receive timely updates. Thank you, and enjoy the video.
The Federal Reserve sees a much bigger problem in the housing market, where housing prices might collapse, in the stock market, where stock prices might collapse, and also just in the enormous cost that the U.S. government has to pay to service a $39 trillion national debt. I think the Federal Reserve realizes that rates need to come down despite the fact that inflation is going up to maintain the ability of the U.S. government to service its debts and to keep the air from coming out of all this asset bubbles that it inflated in real estate, in stocks, in bonds. Now, I don't think the Fed is going to succeed in preventing these bubbles from deflating, but that doesn't mean it's not going to try. And when the rate cuts are not sufficient, and when this new round of quantitative easing is not big enough, all of this is going to be expanded. And that's why these bull market in gold and silver is going to continue. And, I have been really pounding the table ever since I started, I took over the mic on the Schiff Gold Friday market wrap, that everybody load up on precious metals. In fact, I do these on a Friday, and, the markets don't really resume trading until Sunday night, but it's 24/7 at Schiff Gold. You could go to our website and buy gold and silver. You could buy it on Friday night, buy it Saturday morning, Saturday night, Sunday morning. Generally, the prices are pretty much where they closed. And you want to do that. You don't want to wait for Monday, because I think, again, we're going to be very strong on the open. In fact, I expect silver to be back up at the high from today, maybe by Monday. And gold, before gold sold off, Gold was up about 70 bucks at the highs today, and it still closed up over $20, even though silver was down, $1.60, right? Gold held strong on the day, even with this profit taking. But gold got less than $30 away from hitting a new all-time record high. Now, if you recall, on the last Schiff Gold Market Wrap that I recorded, I specifically said that silver was going to hit a new record high before gold. That prediction came true. I also said that gold and silver stocks, the GDX and the GDXJ, which were way off their highs, I said that they were going to hit new record highs or new highs for the year before gold hit a new high. And that prediction came true this week. We had a big move up in the GDX and the GDXJ, both indexes hitting new highs. This is another great sign because in the prior leg of the gold bull market, gold was going up, but you weren't seeing confirmation in silver. You weren't seeing confirmation in the mining stocks. Now we're seeing confirmation by both. Instead of gold leading silver and the mining stocks, it's following. Silver has now taken over the baton from gold. Silver is leading the charge higher. Yes, it's doing it with more volatility, but it is leading. And the gold mining stocks are now leading the metal. You see, in the earlier stages, a lot of people were looking at the gold rally with a lot of skepticism because they weren't seeing the confirmation in the silver market and they weren't seeing the confirmation in the mining stocks because mining stocks investors didn't have confidence in the gold rally. They expected gold to collapse, and so they didn't want to pay up for earnings that may never materialize. And so there was a lot of hesitancy to buy the gold mining stocks. But now that people are buying those stocks, it's because they're starting to realize that these high gold prices are here to stay, that gold's not going to come crashing down. And so these high earnings are going to continue. And in fact, at some point, people are going to recognize that not only are high gold prices here to stay, but they're going to get even higher, that the market's going to keep rising, which means earnings are going to keep rising. And so now stock investors want to get ahead of that. So now we have a more traditional bull market where the stocks are leading the metal, anticipating the increase because stocks are forward-looking, right? Stock investors are trying to predict the future when they buy stocks because they're making a bet on what those earnings are going to be. And when you have a nice bull market where investors expect the bull market to continue, you would expect them to pay up for the gold and silver stocks. That's what they're doing. Now, those stocks are still cheap, but at least they're leading the way. And I've always said that in a real gold bull market, silver outperforms. And up until this year, it was underperforming. That's why earlier in the year, you could buy 100 ounces of silver for 1 ounce of gold. Now, I didn't check the ratio, but I think it's around maybe 67 or something. It's below 70 to 1. Still cheap. Silver is still cheap, but it's not nearly as cheap as it was. And remember, when silver got through 50, what was I saying on this market wrap? That was it. That now we have the double top is now support. 50 is the floor. And yes, I said we could go a little bit below it, and we did. We traded a little bit below it, but all of that was buying opportunity. And now we shot up, and now it's likely that silver's not going back to 50 again. It's not impossible, but it's very improbable at this point. In fact, I still believe that silver is going to hit $100 next year, and gold at least 5,000, probably 6,000, maybe more, depending on what happens in the foreign exchange markets. If we get a dollar crisis, if we get a U.S. Treasury crisis, I mean, we're going to get those crises eventually, so it could happen next year. And if it does, then those upside projections are going to be much higher. But I do think that as the world really gets to think about what happened here with the Federal Reserve and their new policy, You're going to see big buying in Asia in both gold and silver and platinum, by the way. The whole precious metals complex is going higher.
In recent market developments, precious metals delivered a powerful performance, underscoring shifting investor sentiment. Gold recorded a solid weekly gain, closing above the $4,300 level after modest weakness the prior week, while silver significantly outpaced it, building on earlier momentum despite a late session pullback. Year-to-date figures highlight the divergence across asset classes, with both metals posting exceptional advances compared to risk assets struggling to regain traction. Peter Schiff explains that this strength is not speculative enthusiasm, but a direct response to changing monetary conditions, where investors are increasingly positioning for long-term currency pressure rather than short-term price fluctuations. According to Peter, the key driver behind this move is the Federal Reserve's quiet return to balance sheet expansion. Although officials avoid labeling the policy as quantitative easing, the renewed purchases of Treasury securities represent a reversal from prior tightening efforts and signal a renewed commitment to debt monetization. This approach, he notes, is already weakening the dollar while pushing long-term yields higher, an unusual but telling combination that reflects rising inflation expectations rather than economic confidence. As inflationary pressures persist and monetary credibility erodes, Peter argues that gold and silver are responding exactly as they historically do, serving as monetary alternatives in an environment where policy actions contradict official assurances.
Gold prices rose about 2.5% this week. They slipped about 0.5% the prior week, but at the end of the week, we settled just over $4,300 an ounce for the price of gold. Silver had an even bigger week. It rose 6% this week, and that's on top of a 3.5% rise last week. Now, this week's 6% rise comes despite a 1.6% drop today for the price of silver. But before silver dropped 1.6%, it was up quite a bit and then had a reversal. In fact, the high price for silver earlier today, I think, was $64.58. Now, we settled the week lower than that. Let me see where we ended up. About 61.90, so just below 62. But these are big numbers. But before we had that reversal, when silver was at its high earlier this morning, it was up 10% on the week. Now, year to date, gold is up 64%, and silver, based on where it closed, is up 113% on the year. Now, you can contrast that with Bitcoin, which is down about 5% so far in 2025. And we don't have that much time left for Bitcoin to crawl its way back into positive territory. But gold and silver are looking strong, and I think they're going to finish out this year even stronger. I think the big catalyst for the next leg up in both gold and silver is the decision by the Federal Reserve to resume quantitative easing. That announcement came out on Wednesday. Now, officially, the Fed did not launch QE, and they deny that what they're doing is quantitative easing. But that is exactly what they are doing. They're just not fessing up and calling it quantitative easing. What specifically did the Federal Reserve announce that they're going to be doing? Well, they said they're going to be buying treasuries, short-term treasuries, to the tune of about $40 billion in the first month, and then an undisclosed but ongoing commitment to continue to buy. Remember, up until this month, the Fed was selling. They were shrinking their balance sheet as part of quantitative tightening. They announced at the last FOMC meeting, before the one we got this week, that they would be ending quantitative tightening in December. Well, they ended it, but they didn't just stop shrinking the balance sheet. The balance sheet is now expanding, which is what was happening when they were doing quantitative easing. Now the balance sheet is going to expand, but supposedly it's not because of quantitative easing. But that's exactly what they're doing. I mean, the only real difference between what the Fed announced Wednesday and when they were doing quantitative easing is that with quantitative easing, they were targeting longer dated maturities, 10-year treasuries, maybe up to 30-year treasuries. In contrast, now they're buying short-term treasuries, right? A year. But that doesn't really matter. What matters is the Federal Reserve is creating money out of thin air and using that money to monetize government debt, to buy U.S. government debt. The maturity is irrelevant. What's happening is still quantitative easing, which, of course, is just another name for monetizing debt, creating inflation. That is what the Federal Reserve is doing. Now, a lot of people didn't think that this was going to happen. I've been saying for years and years that the Fed would go back to quantitative easing. I'm surprised they were able to hold off as long as they did. Now, the reason they probably didn't want to acknowledge that this is quantitative easing is because they don't want the markets to be worried that the Fed is now having to do this. So they're trying to claim that, well, they're just trying to manage their reserves and they want to make sure that their reserves are ample. I mean, the balance sheet is $6.5 trillion right now. Isn't that ample enough? But they want to have more treasuries on the balance sheet, and so they're going to buy them. That is quantitative easing. And also, it won't be long before the Federal Reserve expands this program and lengthens the duration. So sure, right now they're buying short-term treasuries. It's only a matter of time, and probably not much time, before they start buying longer-term maturities. Now, they're probably never going to admit that what they're doing is quantitative easing, but clearly that's what they're doing. And the reason they're doing it is because they have no choice, because they're trying to suppress interest rates. And to do that, they have to expand the balance sheet. They have to buy more treasuries to get the yields lower. Now, in reaction to the announcement, and this is another forecast that I've been making, the yield on longer-term treasuries went up. In fact, the 10-year treasury yield closed at 4.19, and the 30-year is up to 4.85. So yields rose on the week, despite the fact that the Fed reduced short-term rates by another 25 basis points. They're down at 3.5 to 3 3/4 on the Fed funds. But despite that reduction, longer yields went up. That also means that mortgage rates ticked up, the opposite of what everybody is hoping for. The markets, the Trump administration, they're all looking for the Fed to help bring down long-term rates. But long-term rates are rising. And in fact, because this new stealth QE is targeting short-term rates, they're not buying these long-term bonds. So the long-term bonds are falling and yields are rising. And I think yields are going to continue to rise. And I think it's that backup in long-term yields that is going to be the catalyst for the Federal Reserve to expand the quantitative easing program to include these longer-term maturities, because they're going to want to put downward pressure on long-term interest rates.
Looking ahead, the trajectory for precious metals appears increasingly shaped by structural forces rather than short-term market emotion. Ongoing currency expansion, persistent fiscal deficits, and mounting refinancing needs are likely to keep real purchasing power under pressure, encouraging capital to migrate toward hard assets. As confidence in policy restraint continues to fade, investment flows into bullion-related markets could intensify, especially as institutional allocations remain historically light compared with the scale of global liquidity seeking protection. At the same time, tightening physical availability and rising industrial demand may amplify price movements, particularly during periods of financial stress or market volatility. Any further weakening in major currencies or instability in bond markets could accelerate this process, creating sharp repricing events rather than gradual advances. The next phase may therefore be defined less by steady appreciation and more by sudden adjustments, as supply constraints collide with expanding demand in an environment where traditional financial safeguards no longer feel sufficient. If monetary expansion deepens and confidence in paper assets erodes faster than expected, could the next surge in hard assets unfold far more abruptly than most investors are prepared for? If you found this insight useful, make sure to like, share, and spread this update to others watching the silver story unfold. Your support helps keep these deep dive analyses coming.